Good morning, everybody. Thank you for joining. We appreciate your time. Just a few items of administration before we kick on with the presentation. You're welcome to ask questions at any time during the presentation in the questions box within the control panel on the right-hand side. Only we can see them, so please don't be shy, and we'll do our best to answer as many as we possibly can at the end of the presentation. And depending on the volume of questions asked, we'll gladly respond to any questions that remain following the webinar. If heaven forbid we have any technical problems, please report them again in the questions box. We'll do our very best to help. Hopefully the sound quality at least will be up to scratch. And an hour after the presentation and the webinar, we'll be sending you an email. So please do fill out that feedback form, and then you'll get a CPD certificate and a copy of the session slides. And just as a final point, please do note that the content of this webinar is for a professional advisor audience only. So thank you for your attention again. I'm Russ Mould, AJ Bell's Investment Director. And we're going to very quickly look at what I think may be some of the big issues for portfolio construction and asset allocation for clients for 2019 and frankly beyond. So we're going to touch on these four topics very briefly and leaving again time for those questions at the end. So to start with, this is the bit I'm really good at, telling you what's happened, because let's face it, that's all generally speaking pretty straightforward. So if we'd been sat here a year ago having this conversation, the consensus view of the markets was pretty clear. US economic growth would accelerate, helped by the tax cuts program from the gentleman on the right there, President Donald Trump. That in some would help commodities in emerging markets. And although it would help the US economy, overall, there was a feeling that a lot of the good news was already priced in and that US stocks were expensive and frankly primed to start underperforming after a stunning period of outperformance. Europe and the UK were the preferred homes of the value seekers, along with financials, emerging markets. There was a perception that maybe tech and growth would do badly as economic growth accelerated and cyclical growth became more widely available, perhaps placing less of a premium on secular growth. And bonds, there was a pretty wide range of views, quite frankly, but overall this concept of the Goldilocks economy, not too hot so as to threaten inflation and rapid interest rate increases, not too cold so as to threaten economic growth and therefore potentially the ability to pay coupons. Bonds were generally perceived to be potentially fairly range bound. So that was a consensus, and markets being what they are and the consensus being what it is, that really didn't work out too well at all, and yet again the consensus was left struggling. As we can see from this chart here, looking at total returns in sterling terms for the year to date, the S&P 500 was again the best option equity-wise for client portfolios, followed by Japan. And on the right-hand side, we can see that the emerging markets suffered very badly. The oil share didn't do that well. Europe didn't do that well either, quite frankly. And in the middle, we have a mishmash, but bonds actually are throwing in a negative year. So is gold, and so are commodities. So really, it's S&P 500 first, pretty much the rest nowhere. If you were to do this calculation in dollars, by the way, I think pretty much the only thing that has beaten cash this year is the S&P 500, which is a pretty funny looking bull market in some ways. It's not turned out to be the year that certainly the consensus and other people expected. By sector, to be fair, tech did do well. It still generated positive returns, though it gave up a lot of those in the second half of the year. And the best performers, perhaps rather intriguingly on the left-hand side, again in total return sterling terms, based on the S&P 1200 global indices, were healthcare and utilities, relatively defensive areas. So a bit of a change in mood music. Energy on the right-hand side didn't do that well, perhaps sniffing out the second half decline in the global oil sector before oil traders did. And again, on the right-hand side, industrials haven't covered themselves particularly in glory either. So an intriguing tint to sector performance with relatively defensive areas doing best. So again, perhaps not the mood music that the market had been expecting. Now, why this change? Well, we all know that markets like to climb a wall of worry, which is why I put this photo up on the right-hand side. And the good news is, in that respect, there's been lots of things for markets to worry about. Is the Fed tightening monetary policy too quickly? Will it even lean towards a recession? Equally, we've had concerns, will the US economy actually overheat? We've got this constant debate over trade and tariffs and President Trump's Make America Great policy. I'm hoping, this is the time I mentioned Brexit. Will Italy and the EU come to blows? Rising oil prices, that's now less of a problem. Oil prices are actually now slightly down year on year. but there was certainly a concern in the first half of the year. Global indebtedness is a third higher than it was 10 years ago, which is a pretty frightening statistic. The dollar was getting stronger, geopolitics, a constant concern, and also the nagging issue of maybe this is just as good as it gets. And we'll give you an example of why that is legitimate fear. But I would probably be prepared to say that they are all generally known unknowns, to use Donald Rumsfeld's phrase of a few years ago. But they've certainly all been issues. They've been rattling around for analysts, economists, and indeed advisors and clients over the past 12 months. So just looking at some of these known unknowns, for me, this has probably been the biggest issue of all in 2018, a slow draining away of liquidity by central banks, particularly the US Federal Reserve. This looks at the Bank of England, Bank of Japan, European Central Bank, the Fed, and the Swiss National Bank, and it looks on the year-on-year change in dollar terms in those central banks' balance sheets. Now, the Fed has begun to withdraw QE. It's now running that at up to $50 billion a month. The European Central Bank has tapered away its additions to zero from December. The Bank of England hasn't added for a couple of years. In fairness, the Bank of Japan and Swiss National Bank are still hard at it, although the Bank of Japan has actually undershot its targets once or twice recently. But the net result, particularly of the Fed draining away liquidity, is that big plunge on the right-hand side, and you can start to see that actually come the end of this year, there'll be very little net new stimulus. Now, we can see in previous occasions when stimulus has died down, equity markets, looking at the FTSE All World, have lost momentum, and as a result, central banks have actually stepped in relatively quickly afterwards. Now, Fed Chair Powell, so far, has been made of tougher stuff. He's been quoted on several occasions saying that it's not the Federal Reserve's job to stop people losing money in the financial markets. Now, intriguingly, last night's comment from Chair Powell that we're nearing, quote, neutral on Fed US interest rate policy has got people excited that the Fed isn't going to metronomically push ahead with 3 or 4 interest rate increases next year either. I think, if this is the appearance of the Powell put, I'd be pretty disappointed because it's a pretty weak response to a very minor correction in US and global stocks. He may be responding to pressure from President Trump, though I hope not. Equally, I suspect what he is looking at is a weakening in the US housing market, the US auto market, and the fact that the US is just so much more sensitive to interest rate changes than it was because it's so much more indebted. But for the moment, the Fed is sticking to its course of draining away liquidity, and that is having an effect on risk assets which have feasted upon cheap money for most of the last 10 years. This is a key theme going forwards. Will the Fed stick to its plan, or will it bottle it, for want of a better turn of phrase, in the face of either a weakening in economic data or a weakening in financial market performance? Oil is now less of a concern, as I flagged earlier. It's now broadly flat to down year on year. And the reason I put this chart up is that if you can see here, once oil is up between 50 or even 100% year on year, that starts to affect global GDP growth. We haven't got to that point. We got to oil up 50 to 60 at some stage this year on year. Haven't got there now. This is one less thing for us to worry about right now, I would politely suggest, for 2018. Let's see that 2019. Let's see what OPEC say at the Vienna summit next week. But for the moment, oil between $60 and $80, I think will probably suit financial markets just fine. Thank you very much indeed. The dollar, it's kept on going up. There's been an accusation it's the consensus view, but oddly enough, that hasn't stopped it going up using the DXY, trade weighted basket or index, or DXY as it's commonly known. And a strong dollar is traditionally seen as inherently deflationary. It makes commodities more expensive because they're dollar priced, and it makes it more expensive for dollar borrowers, notably emerging markets, to service those debts. That's what's tripped Turkey up this year. It's what's tripped Argentina up. And as a result, emerging markets took a bit of a thrashing, partly because of the stronger US dollar. Now, you can easily argue that one or two emerging markets, possibly Asia, were unfairly thrown out with the Turkish and Argentinian bathwater. But nevertheless, that apparent relationship of dollar up, emerging markets down, or vice versa, again proved pretty strong in 2018. If the Fed presses ahead with 3 interest rate increases next year, got to be a fair chance of a stronger dollar, more strife in emerging markets, although they have begun to stabilize recently. And again, if Mr. Powell backs off, that might be the sort of music that the emerging market investors want to hear. I should say that DIX is currently only at 97 or 98 on that scale. As you can see here, it peaked at 120 in 2001. And if I take it back to 1985, it actually peaked at about 160. So if the dollar really does go bananas, it could go up an awful lot further from here. And this is as good as it gets. It looks at the Conference Board's US Consumer Confidence Index, which is basically trading at multi-year highs right now, 2-decade highs, as good as it's been since the early 1990s. And all I'm saying here is that, generally speaking, when US consumers are this confident, it does prove to be as good as it gets. Now, that's no crime, but if this is as good as it gets, then it's not going to get any better. And if it doesn't get any better, then it might get worse. And stock markets don't like to think about things getting worse. And I think there is, you've actually seen consumer confidence just dip in the 1 month whereby we've had equity markets dipping. And again, I think there is an increased link between consumer confidence potentially and stock market and financial asset performance, which again may be why Fed Chair Powell is just stepping a little bit more gingerly than he was even a month ago when he was expressing no interest in financial market movements whatsoever. But again, this is one of the still a known unknown, not an unknown unknown, but it's something that we all need to be aware of, that in the end, financial markets are at their most dangerous when making money looks easiest and the economy looks strongest. So it's something we all need to be aware of. Now, when I did this presentation for the at the actual AJ Bell Investorville a couple of weeks ago, it was a 1970s themed event, which is why we had the rather wacky colour scheme that you're looking at now, lots of oranges and purples and reds, and why I chose these pictures here, just to show what a strange decade the 1970s were. On the left, we actually had Leeds United, my beloved team, winning championships and performing fantastically on the pitch. In the middle there, we had our good friends from AJ Bell Investcentre, Billy Mackay and Gary Dale, misbehaving themselves on the weekend. At the bottom, we had Richard Nixon, the US president, who had to resign to avoid impeachment. And on the right-hand side, we have Tom Baker as Doctor Who. So we actually had a man playing a leading BBC character, which was normal for the time, is less so now. So what was the real theme of the 70s from an investing perspective, to get more serious? It was inflation. Look at that chart on the left-hand side. Inflation peaked in the mid to high 20s in the US and the UK, for example, and even reached, a fairly decent 5 or 6% clip in Germany, and even Japan. It was pretty high as well. And that's why Paul Volcker at the Fed stepped in to crush inflation, jacking US interest rates up to double-digit levels in the early 1980s. But on the left-hand side, we can see in the 1970s, hindered by an oil price shock, hindered by Nixon taking America off the gold standard, so that he could basically print money and afford to fund the Vietnam War as well as American welfare programs, inflation went bananas. And for most of a decade, central banks couldn't stop it. If we look on the right-hand side here, what's characterized this decade is that so far, central banks haven't been able to kickstart it. Despite something like 12, 13, $14 trillion worth of quantitative easing, a decade's worth of zero or negative interest rates, inflation, they've just not been able to conjure it up. There are some nascent signs that we're getting there. As you can see, the numbers are nudging up a little bit, mainly because wage growth is finally starting to tick up as we get unemployment numbers at 10, 20, 30-year lows in the US, in Japan, and in the UK. Europe is a bit of an exception there with an unemployment rate in the EU, at least, of still some 8.2%. But this is what's odd, is that the 70s were all about inflation. This decade, the 10s, are really all about its absence. And I think if there is, therefore, a major surprise coming up, the unknown, maybe it will be the return of inflation, because in the end, it's what central banks have been absolutely busting a gut to try and generate. Now, why would it matter if it came back? Well, this just looks at the S&P 500, I've used the S&P 500 because I can get the numbers to go back the farthest, and it looks at annual returns on an inflation, and it looks at the index, not annual returns, the index on an inflation-adjusted business. So we can see 4 black lines there. You got the one on the third one, the second one from the left. That's a period of deflation, the Great Depression in the 1930s. The third from the left, the one that shows the 1960s and 70s, that was inflation. Although stock indices actually went up during that period, inflation went up more. And if you put money into the US market in 1967, it took you the thick end of 20-odd years to actually get your money back in real inflation-adjusted terms. And then on the far right-hand side, the third line, that's just the impact of the technology bubble bursting and excessive valuations taking time to work out. If you piled into the US in 1999, you didn't get your money back until, the 2010s effectively. So timing of markets, as we know, is very difficult. but inflation can have a major role in returns that clients get from their equity exposure. And it's this inflationary one in the 70s that I think would be perhaps the biggest surprise, because since the early 1980s, we've been treated to disinflation, we've been treated to falling interest rates, and that has been a dream scenario for particularly for equities, but for lots of different asset classes, fixed income as well. But if inflation came back, a lot of what we've seen for the last 30 years, which would cover all of my career in the financial markets, I started in 1991, and certainly a lot of everybody's listening now, I would think a lot of the sales tactics and strategies wouldn't work anymore. Now, on the right-hand side here, I know it's a 1980s film, I couldn't quite manage that. That's Dan Aykroyd from the original Ghostbusters. Now, the reason why he's looking shocked is that when he goes to buy the ambulance that they turn into the Ghostbusters mobile, he remortgages his apartment and does so at a rate of 18%. Now, yeah, given where current mortgage rates are in the US at 5%, that seems pretty odd to me and frankly to anybody listening. But just because it hasn't happened for a long time doesn't mean that it can't happen again. So if we did get higher inflation because of either a breakthrough in wage growth, because of central banks just simply overdoing it for too long, or even panicking in response to a financial market downturn and pushing more QE out there, in response to an end of austerity, under populist electoral pressure, governments are replaced or cave in and start to hit the fiscal stimulus button. The combination of all those three could be very powerful. We don't know, we can never say never, but it certainly isn't what markets are expecting right now. But if you did get higher inflation, you did get higher interest rates, then again, everything that's basically worked during my career since 1991 might not look quite so good going forwards. Long-dated bonds would be a painful place to be. Long-duration assets like tech or biotech generally find it harder work during periods of rising interest rates, because the discounted cash flow model the maths of the discounted cash flow model starts to work against you. You do have to start asking your fund managers again under an inflationary scenario about pricing power, an issue that Warren Buffett never ceases to talk about, but has largely kind of fallen out of fashion in the last 5 or 10 years, when companies that lose money hand over fist are frankly more highly valued than those who make an awful lot of money. Growth strategies wouldn't work. If there's lots of inflation and lots of nominal GDP growth, then organic secular GDP profits growth might not be so highly valued. And we may again need to talk about real assets, whether that's property, gold, farmland, whatever it happens to be. These things, again, which have largely fallen out of fashion for most of the past decade or two, would again start to perhaps become an area of fresh focus. So if there is an unknown, and I'm saying if, inflation would certainly be a big game changer. We could get deflation. I can make an equally powerful argument in case of that. Quite frankly, debt, demographics, the dollar, all very deflationary, all lurking in the background, and technology remains probably the most powerful deflationary force of all. But certainly if we did get inflation, that would be a game changer. And just to show you before, it's happened. And this is not by any means to poke fun at Newsweek, as somebody who's paid to, analyze and write and occasionally pontificate live on air for a living. I know how hard it is to be, put in a situation whereby you have to make a forecast, particularly when you've got a microphone under your nose at very short notice. This is Newsweek, Business Week from 1979. Headline: The Death of Equities, How Inflation is Destroying the Stock Market. Yep, that's exactly where that magazine was published, right before inflation peaked and right before a 20-odd year bull run in equities. So that is how hard it can be to make forecasts, and it also shows just how easy it is to be influenced by the experience you've had over the past 5, 10, or even 15 years. The 70s, as we've seen already, were all about inflation, were all about poor returns from equities in inflation-adjusted terms. So it's probably no surprise that the lady or gentleman at Newsweek wrote an article saying it's looking pretty tough going forward, because that's what they've been used to. But, as we know, nothing lasts. It's highly likely that anything lasts forever, and we can certainly construct scenarios whereby deflation comes through, or I think probably less expected right now, inflation comes through. So in conclusion, we probably need to be prepared for all eventualities: inflation, stagflation, deflation. The disinflationary period that has served us so well may continue, but there are so many forces out there that could knock it off course: central bank policy, end of austerity, very low unemployment. There are lots of things that could start to move the goalposts. If it's inflation that results because of an end to austerity, further central bank laxity, wage growth, whatever it happens to be, we'll need to start thinking in terms of some strategies that have worked before, but maybe have not been so relevant for the last 10 or 20 years, like pricing power. Certainly volatility you would expect would start to go up. Markets have been so supine, so drugged by cheap central bank cash for so long. You would expect that things to get more volatile, particularly if we're confronted with a world that we haven't seen for, say, 30 or 40 years. And as we all know, one way in which we can try and protect our downside and clients' downside is by seeking out the value, the unloved. Value has been ice cold for so long. It flickered in 2016. It's flickered a little bit in the second half of 2018. But at least by trying to pay respectable valuations for assets, we can at least protect the downside if something unexpected starts to happen. Now, how do you go about seeking out those assets? Well, here's just one example of what, first of all, a master of whether he's a value investor or not is a point of constant debate. He never talks about necessarily value. He talks about a fair value for good assets, or liking to buy discounted assets. And this is what Warren Buffett's been doing with his Berkshire Hathaway portfolio, going back here, as you can see, to 1999. But what's really interesting me is what's happened in the last 2 or 3 years. This just shows the percentage allocation of Berkshire's assets between cash, the orange line, fixed income, the red line, and equities, the sort of purple line. And although the one that's been getting all the attention is the orange line, cash, which in dollar terms is basically at record highs now at just north of 100 billion US, what interests me is the fixed income allocation. Buffett, a man who is known for not wanting to overpay things, has basically let his fixed income allocation run down to a record low in the very low single digits. Now, Buffett does not make macro calls. He is so clear about that. But he does make value calls. And he clearly thinks with bond yield, or I can only draw the inference from this data, that Mr. Buffett is maybe thinking that bonds right now don't represent great value. And certainly if there is inflation coming around the corner, they represent rank bad value. So that's certainly, one opinion I would respect. Now, it's interesting to see equities, not quite at these record high percentages, but getting there. And one of the reasons that Buffett's cash pile has been going up in absolute dollar terms is he said he's having trouble finding a decently valued deal. So he's just sitting on his hands at the moment, waiting to see what happens. Finally, so John Templeton, another legendary investor and very successful one, said that bull markets are born on pessimism, grow on skepticism, mature on optimism, and finally expire and wither on euphoria. And so what I've just tried to do here is look at where I think, based on customer feedback, client feedback, valuations, performance this year, where there may be pessimism and skepticism, areas that may be providing us with some downside protection if things go wrong because they're cheaper, and areas that perhaps we may need to be more wary of because they're more of a consensus view, or valuations are perhaps less attractive because they've just done so brilliantly for such a long period of time. And as we can see here, we would certainly put bricks and mortar retail and real estate investment trusts in the market doghouse right now. I'd put sterling and UK equities in there as well. In total return sterling terms, the UK has underperformed something like 9 years in 10 now on a global basis. Precious metals out in the cold. Gold's done nothing this year for some time. Emerging market equities, which were pretty hot at the start of the year, have now gone back into the cooler. And I think certainly in the case of Asia, that does seem to be presenting a value opportunity potentially. And value investing overall, as we know, that style has just struggled for such a long period of time now relative to growth and momentum. Still lots of skepticism with regards to banks and financials, bank stocks. One of the things that probably worries me most right now, Deutsche Bank shares at 1982 levels, Greek banks shares hitting new lows, banking indices underperforming in the US, UK, Japan and Europe. For all of the Bank of England's relaxation yesterday with its stress tests, the market isn't convinced. It thinks there may be something wrong. So that has definitely got me on my guard. Market still to be fully convinced by Abenomics in Japan, still to be convinced by Europe. Optimism, US equities, oil, which interestingly, in the middle of the year, futures contract speculative positions were at all-time highs in oil, and lo and behold, it's started going down. So that's begun to unwind. And then in terms of euphoria, we know that some of the gloss has come off this, but FANG, Chinese web stocks, small cap biotech stocks still all did brilliantly in the first half of the year. They've begun to lose their luster in the second half, so maybe there's a little bit of the euphoria being knocked out of them, but still very little bearish commentary and lots of optimism surrounding them. Investment-grade corporate bonds, with 40% of those now rated BBB in the US in terms of issuance this year, you've got to be a little bit worried that the premiums we're getting don't compensate for the risks. Index proliferation does worry me. We love ETFs. Can be very useful, cheap tools for diversification. But when there are more indices than there are stocks worldwide, you may end up with a situation whereby the tail is wagging the dog. And momentum investing has been a phenomenal success. But as the FANG, BAT, Chinese web stocks begin to cool off, that might not look quite so smart either. So that's just over 25 minutes. We've left a few minutes for questions at the end, and I will be delighted to take some questions. And the first one is a really good one. Can you explain what I mean by pricing power a bit more? Yeah, with pleasure, and I can do it with going back to Mr. Buffett. He called his company Berkshire Hathaway, and he named it after one of the acquisitions that he did, which went wrong. And the reason that it went wrong was that the company, in his view, had no pricing power. Berkshire Hathaway made suit linings. Now, if you go into a shop, and I'm not going to lie to you, I'm wearing a Paul Smith suit right now, and I wear them because they fit. Not because I'm particularly vain, hopefully, but I go into a shop and I specifically look for a Paul Smith suit because they fit. I know that they're well made and they will last. So I'll be prepared to pay that little bit extra because I know I'm getting a Paul Smith suit. I don't give a monkey's where the lining comes from or the cloth comes from. So I'm not going to buy a suit because it's got Berkshire Hathaway lining in it. I am going to buy a suit if it's got Paul Smith on the brand. That is pricing power. Now, where do you get pricing power from, therefore? There are several sources. Brand is clearly one, and that's why companies like Burberry throw lots of money at it, or LVMH for their champagnes and their luggage, or Ferrari for its cars. So that's one. Another, you would argue, is powerful market share. If you've got a sufficiently big market share and can crowd out a lot of the opposition, then you clearly have potential to have some pricing power. Another one is a technological edge. Ask Apple. Apple is currently jacking its prices up for its smartphones, not down, and that's because it believes it has a strong enough market share and a sufficiently loyal customer base that it can afford to do that it can take that chance. Another one you could argue would be an installed base of kit. If, for example, you are a manufacturer of elevators, at least once a year you have to send a man or a woman with a bag of tools to go and service it and make sure that it's still working, so that it doesn't go from the top floor to the bottom floor in the department store and damage all the people inside it. That's bad for your business, but it's also bad for the department store's business. The department store will pay you to make sure that their customers are not damaged by the lifts. So those things like an install base, like a strong brand, like market share, for example, and like a technological edge, will enable companies to a degree to charge the price that they want to charge, not be forced to charge the price that the customer is willing to pay. And that's the big difference. And Buffett's classic description of this is, if you've got a business where you can put up prices, you've got a potentially good business. If when you put up prices you have to have a prayer session, then you potentially have a bad business. And I think that's the definition. And that's why, for example, print media, which, bless it, is being hollowed out by the internet. Because there's lots of information available for free online. People don't feel a need or don't want or don't believe they're getting sufficient value in sufficient numbers to go out and pay for print media. And that's why print media is struggling. So that's a classic example of how pricing power has been taken away from a business. So that's what it is. Sectors that traditionally you would look towards for pricing power would be things like luxury goods, consumer staples, beverages, food are areas where traditionally they've been quite good. Up to a point, anything you can stick down your throat or stick down the sink. So in the UK, stocks like Reckitt Benckiser, which makes Sillet Bang, or Diageo, which makes Captain Morgan rum, Johnny Walker whiskey, Guinness, for example. People will probably potentially pay a premium because they like those brands. They see them everywhere. They see other people drinking them and think they're cool and they're tasty. And so that is pricing power. It's been it's not been a big issue over the past few years because there's been very little inflation. And again, markets have been prepared to fund and back companies that are actually losing money hand over fist. Netflix, which is now making money but still consuming cash, I should say, or Tesla, or Twitter, for example. Now, Twitter is a case in point. I occasionally try and get down with the kids and do some teaching on financial markets and how they work and what they need to look for at schools. And I do it from 6 all the way up to 18. And so I try and get down with the kids and ask, certainly the 16 to 18-year-olds, how many of them use Twitter? And the first answer is generally now not very many, which is in itself quite intriguing. And they use Instagram or Snap or other tools. And I then ask, well, would they pay to use Twitter? No hands go up whatsoever. And I ask, would they pay to use Snap or Instagram? And I can assure you, no hands go up whatsoever. They don't particularly want to see advertising on them either, by the way, which, again, if you've got a service for which you cannot charge and your customers will not pay, I find it hard to put a value on those companies. Now, that's just my opinion, but, Gravity is certainly now working its magic on Twitter and Snap, for example, because they're providing services which customers do not value sufficiently highly for them to wish to pay for them. So I hope that helps. We're coming towards the end of the 30-minute session, but please, if you have any more questions, you're welcome to get in touch with your business development manager or email us directly, and we'll gladly help out. But thank you ever so much for your time, everybody. We greatly appreciate it. And I know it's not quite December yet, but I'd certainly like to wish you all a very successful and prosperous new year, and we look forward to staying in touch.